The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to this Friday edition of Squawk Box Europe. I'm Steve Sedgwick with Karen Cho and Juliana Tattelbaum. And these are your headlines. China says it is considering tariff talks with the United States after the Trump administration reaches out, saying Beijing's door is always open.
Apple and Amazon fall in extended trade despite earnings beat, says tariff uncertainty weighs on the outlook for big tech.
And Standard Chartered posted 10% rise in first quarter net profit, maintaining its guidance despite heightened uncertainty. The lender's CFO discusses the impact of trade tensions.
Whatever the end state of the world will be, it will be a more complex world. It will be a more complex and probably a more fragmented world. And in that complexity and that fragmentation, again, augment the value of the products that we offer and augment the value of the access to the network.
All right, a lot of numbers coming out from big UK corporates at this hour as ever as well. I am going to start off with Shell because one thing we are seeing at the moment is that a lot of companies are worried about tariffs in the future. A lot of companies are worried about the impact going forward. Where the oil price has been unequivocal, it has cratered. And we've only just, with the news of those potential Iran sanctions, got back above $60 a barrel for Brent, which is way below where the NOCs, IOCs, that's the national oil companies and the international oil companies, where they need it to be to make proper money. But anyway, the first quarter cash flow from Shell, one of the biggest majors on the planet, $5.3 billion US. The adjusted earnings, though, better than expected, it looks like, in the first quarter compared with the miss we saw in the fourth quarter, $5.58 billion US. The IBES estimate was for 5.09 as well. Net debt, it's under previous management, under Ben van Beurden and under Wael Sawan. This is an area they want to get down as well. Net debt, $41.5 billion US as well. The buyback, I think I saw earlier on, is pretty much in line. Here we go, with what we saw in the fourth quarter at $3.5 billion as well. So the uncertainty surrounding the Shell oil price. Well, let's take a very quick look at where the shares have been trading as well, because I'll show you the right-hand side of the screen. That is very little to do with the underlying operational efficiencies from Wael Sawan and his team. That is about the underlying oil price. And as I say, OPEC Plus, pretty much today, what are we, May the 2nd? By the way, good morning, Karen. Good morning, Juliana. May the 2nd, we've got OPEC putting barrels back on the table. You've got a US administration that, despite the pleas, I guess, from the industry to try and do something to hold the price up, is trying to get drill, baby, drill. So more production, less potential demand, and that is a toxic mix for Wael Sawan, the CEO of Shell, who will be on CNBC later on today, 4 p.m. London time. I will be watching that interview.
Just moving on to NatWest this morning, and I was looking at this early on, Steve, one for you. This is the last earnings report before the UK government completes its divestment of the bank. So a long legacy issue here as we talk about that government ownership. But what jumps out to me, we talk about NatWest, we think about deposits, real consumer bank, but even with the huge swings on capital markets, there's been some impact in the business. And this is the stronger performance it's citing in particular in currencies and capital markets. That was one of the strong arms, offsetting the reduction in the amount recognised under the profit share arrangement with its subsidiaries. So there's a few swings and roundabouts here, but let me get into the numbers that we're seeing. The Q1 operating profit before tax at £1.8 billion. ROT, it's been extraordinary from this bank, 18.5%. So very strong still on that metric. The net interest income, that was just over $3 billion. And what jumps out to me, though, the impairments. And as we talk about the uncertainty on the horizon thanks to tariffs and the economic story on the back of those tariffs, the bank also citing some of that. And to me, it looks as though the impairment charge has gone up as well in that first quarter, £189 million. So again, there is a line there showing you about those headwinds and you could say tailwinds on the capital markets side for the bank, Steve.
Yeah, I just want to remind everyone that NatWest bailout, It was the RBS bailout, and there's a lesson for our times here, because just going back into the early history, of course, Fred Goodwin, the boss of Royal Bank of Scotland, beat Bob Diamond to the hand of one of the big Dutch banks in the early noughties as well. They became one of the biggest banks. They wanted to be a global bank. They wanted to be an investment bank. RBS, of course, in 2008 had over-leveraged themselves. They plummeted. The government bailed them out. The government then split it up, and then, of course, it's now called NatWest as well. So what a massive change. And when we're considering looking at HSBC, as you say, pulling out of Europe on IB as well, we've got concerns about what UBS, Deutsche and Barclays, who are the three left in that area, can do on the IB side as well. What a huge change we've seen in the last 18 years.
Well, I think bringing it back to what we're hearing today, I mean, certainly that context is helpful for thinking about where NatWest is positioned. But looking at the numbers today, the guidance seems pretty upbeat, especially on the back of what we heard from Barclays around their upgrade to NII. NatWest is also sounding pretty optimistic. They're looking to achieve a ROTE at the upper end of their previously guided range. They're also looking at income coming in at the upper end of their previously guided range. So in terms of the banks, it's obviously been volatile from a trade perspective, but the outlook sounds pretty upbeat.
Well, may well be. We'll come back to this. I know we want to talk about this as well. China's Commerce Ministry said Washington has approached Beijing to find a resolution. Oh, the narratives here. Anyway, Washington has approached Beijing to find a resolution to Trump's 145% tariffs. In a statement, the Commerce Ministry said it is evaluating US overtures and urged it to correct what it called erroneous practices and cancel unilateral tariffs.
Apple shares are lower in extended trade as weakness on some key metrics and downbeat tariff commentary outweighed a top and bottom line beat in its fiscal second quarter. Overall revenue was stronger than expected with iPhone sales ahead of forecast, but the company's closely watched services division missed estimates and sales in China fell more than expected, down 2.3% amid rising competition from local players. CEO Tim Cook told analysts that tariffs are expected to add $900 million to costs in the current quarter, assuming no major policy changes. But he suggested that figure could change in the future, saying unique factors benefited the outlook for the current quarter and warning that policy uncertainty makes it very difficult to predict beyond June.
Well, Juliana, to the other big tech titan, Amazon shares are also lower after a softer than expected outlook and a miss on Amazon Web Services revenue, AWS. It overshadowed a first quarter beat. Those AWS sales grew 17% on the year, falling short of consensus. For the current quarter, Amazon projected weaker than expected operating income of $13 to $17.5 billion and said tariff and trade policies pose a risk to earnings. Amazon CEO Andy Jassy told analysts he believes the company is well positioned to deal with the impact of trade tensions.
Obviously, none of us knows exactly where tariffs will settle or when. We haven't seen any attenuation of demand yet. To some extent, we've seen some heightened buying in certain categories that may indicate stocking up in advance of any potential tariff impact. We also have not seen the average selling price of retail items appreciably go up yet.
Well, let's get to Arjun for more on both of these companies. Arjun, let's kick off with Apple. To me, the big number in the room was the $900 million that it's saying will add to its costs in the June quarter. And of course, where these products are going to come from. India, the factory floor now for those iPhones into the United States. Vietnam for everything else badged Apple.
Yeah, it was really interesting. So that we got that commentary, the 900 million number. I think what was also interesting was the uncertainty that reigns through. Even Tim Cook saying it's difficult to predict beyond June what's going to happen in terms of tariffs. We had very similar commentary for Amazon as well. But the supply chain, half of US iPhones, Tim Cook said, or more than half are coming from India. And we've seen over the last couple of years, Apple really ramp up production there as well. And the other part as well, most other products into the US are coming from Vietnam. But that doesn't mean that there aren't still China products. There are still products coming from China, but you are seeing that some of the investments that Apple have made in particular in India, in particular in Vietnam, are starting to sort of help out somewhat, but they still cannot get away, I think, from the fact that they still rely so heavily on the Chinese market for production.
There are casualties here, and one is the buyback program. Some of the funds will come out of that buyback program as we talk about the elevated costs, but I also wonder whether the innovation story has been derailed by this enormous focus on the supply chain and where the products are being produced. And we were talking about this in the show yesterday. What about Siri? I mean, Tim, this is meant to be the gold standard effectively in AI when you've got such a big technology company, and yet we heard from Cook yesterday that Siri needs more time to complete its upgrade.
Yeah, it's taking a bit longer than we thought, Tim Cook
It's not
said.
24 hours when you press that button.
Yeah, look, I think that the tariff, the geopolitics around Apple in particular, this has become sort of the company that's really been caught in the crosshairs of this, and it has overshadowed, I think, some of the things Apple is doing with Apple Intelligence. The company has said, well, Tim Cook said that in the March quarter, the markets where Apple Intelligence has been rolled out, they did see stronger year-on-year growth for iPhone sales than other markets where it hadn't been rolled out. But I think still, there are a lot of questions over Apple Intelligence, how quickly it's being rolled, and actually the impact it's going to have on iPhone sales. There hasn't been this sort of massive uptake and drive towards buying these new iPhones because of Apple Intelligence as it stands. So I think the key is, going forward, there's a Worldwide Developers Conference coming up in June, and I think that's going to be very critical for the Apple innovation story going forward. What Tim Cook says there, what Apple management says there, and actually the sort of roadmap for Siri in particular and some of these other features, and whether that then drives the next upgrade cycle into the iPhone 17, which I think a lot of people are looking into. And of course, if there's a thinner iPhone as well, the iPhone 16e, the sort of slightly cheaper iPhone, was interesting. That did help keep iPhone 16 sort of family series pretty strong in the quarter, and that helped some of the sales. But clearly, I think there's a lot of eyes now on the next generation, how much Apple Intelligence is going to drive towards that iPhone 17.
Arj, let's talk about the current iPhone. We had been talking about the potential of U.S. consumers trying to get ahead of tariffs and front load their purchases of iPhones. But it sounds like Tim Cook said they're not actually seeing any signs that people were going out and trying to get a hold of these phones before the tariffs kicked in.
Yeah, and I wonder if that's also speaking to some of this questions over the innovation, whether there's a lot of consumers are saying, you know what, I think I'll just wait for the 17. There is a bit of that. Anecdotally, people I've spoken to have said, well, I want to upgrade, but I'm not quite sure. There's nothing really massively new. Apple Intelligence, again, massive features haven't rolled out. So I think there is a bit of wait and see around price increases to some extent, but also around actually what does come next.
Can I just point out, we do a new segment now, Big Number, and it's brilliant. But I want to do a new segment. It's called Teeny Number.
Teeny number.
Which is your
Notice
teeny
the
number.
high-pitched teeny as well. I think it was very important to make the point. Vocabulary emphasis. You know about that. You do improv. Teeny. Look, one bit I'll do big number versus little number. Big number, $100 billion of buybacks. $100 billion. That's bigger than most companies on the planet. Teeny number, so far, and I appreciate it's only so far, 900 million of extra costs in the quarter. So Karen and I had a lovely ding-dong yesterday about whether we're seeing it now, whether the market's seeing it now, or whether it's to come. And I don't know. I genuinely don't. But come on. If a company that's giving back $100 billion, and it has only got $900 million of extra costs, seems to me at the moment the story's intact.
Pocket change.
It's
When you look at
nothing
services,
to a man like you.
when you look at services.
You lose
alone,
more than that on the tables in Vegas where you've just come back from.
But look, it is a small, and I think that is speaking to a little bit around what Apple's done in terms of investments on the supply chain in India, particularly in Vietnam and other areas as well. But I think that the key here is really that comment from Tim Cook is, yes, we can sort of see into the current quarter, but beyond that, it's very difficult to know the level of impact in here. And I think the big question is whether Apple will need to increase prices on the iPhone and whether that does hit demand at all.
Amazon. AWS, that was disappointing, and it's fascinating because we've heard from some providers in this space about the role of cloud still and how it's helping companies manage supply chain logistics, which have gotten a little bit more complex again. But the reality is Amazon was not kicking out of the ballpark on cloud, and we know there are huge challenges in the retail business thanks to tariffs. What was your reading on what Jassy was saying?
Another big number, $105 billion. That's how much Amazon has said that it's going to spend this year on CapEx in terms of investing in data centers in some of these chips. That's a huge number. Now, for it to see growth of 17% year on year, where you've got Microsoft Azure posting 33% growth, you've got Google Cloud posting stronger growth as well. That's going to be a bit of concern, I think, for a lot of investors here as well. The fact that Amazon is investing so heavily in a lot of this AI infrastructure, data center infrastructure, but it's not seeing that rapid growth that other companies are seeing I think there's a lot of question marks over that, and there will be questions now asked about actually where does Amazon stand in its AI product offerings versus what we've seen with Microsoft. Microsoft came very strong out the gate with the OpenAI investment and some of those products in its cloud computing division centered around AI. It's not been the same story for Amazon, and there's a question now whether it is a tech laggard in terms of the AI sort of offerings via its cloud, particularly when it's spending this much money.
Arj, fascinating stuff. There's a lot more to talk about with regards to these two behemoths, but we'll leave it there and pick it up later in the show. Coming up on behemoth. This is, I think the audience has to get used to this. We're gonna be going back and forth a lot in the coming weeks. Coming up on the show, U.S. de minimis trade rules are scrapped. We'll break down what the latest developments in Trump's trade war means, particularly for Chinese retailers after the break. Plus, Beijing says the door is open to trade talks with the U.S. We'll discuss the next steps. And UK local election results are trickling in, with Reform UK winning its first by-election. We'll be joined by Philip Rycroft, former permanent secretary for exiting the European Union, at 8:30 BST. Welcome back. We're taking a deep dive into the impact of changes to the U.S. de minimis rules for imports, which have now come into effect. Before President Trump's changes, the U.S. had one of the world's most generous de minimis thresholds, allowing duty-free entry for shipments valued below $800. Now, from today, low-value shipments into the U.S. are subject to tariffs and fees. De minimis rules have come into focus in recent years as the value of goods imported into the U.S. under the exemption has grown rapidly, fueled by the growth of low-cost Chinese e-commerce players. Trump's announcement has already hit that sector, with Temu and Shein falling from being the most popular free shopping apps on Apple's App Store at the start of last month to being ranked 13th and 8th, respectively, according to data from Sensor Tower. E-commerce names have been cutting back on ad spending in the U.S. ahead of the changes, with Meta and Snap flagging the issue in their earnings call. And interestingly, yesterday, when we heard from Amazon, they said they actually stand to gain market share on the back of changes to the de minimis rules and what's happening with tariffs more broadly. Let's take a look at U.S. markets, because we saw some pretty interesting trade stateside. And I say interesting because despite all the uncertainty that remains in the air, we saw more gains for Wall Street. All three of the major indices moved higher. NASDAQ out in front, gaining 1.5%. U.S. markets now on pace for back-to-back weekly gains for the first time since January. And leadership has come from the tech sector, from cyclical parts of the market. It's not the defensives, which you would typically expect to outperform if we are headed for an economic downturn. Asian markets are taking a cue from Wall Street. We've seen gains for the most part there. You've got the Hang Seng over in Hong Kong up more than 1% this morning. Nikkei 225 also gaining some ground. The Shanghai Composite a little bit weaker, down about 0.2%. European futures. Yesterday, the majority of Europe was closed for May Day, the Labor Day holiday. Now this morning, reopening. We are looking at gains for Europe as well. A little bit of catch up there given the closure yesterday. So Stoxx 50 futures indicate about a 1% jump at the open. FTSE, which was open yesterday, looking to gain about 0.5% after a basically flat session yesterday. Getting over to futures on Wall Street. Here's the picture. You've got more gains in store. This time, leadership coming from the Dow Jones. At this stage, the Dow is looking to open about 270 points higher. Let's get out to Nomi Prinz, founder of Prinsights Global. Nomi, great to have you with us. The U.S. market has staged a pretty stunning comeback. When you look at trade over the last couple of weeks, we're now looking at potentially back-to-back weekly gains for Wall Street, despite all of the uncertainty that remains on the horizon and all of the concern that we've heard from CEOs over the last 2 weeks. Why are markets rallying?
I think markets feel like the worst is either over or being communicated right now. And it's interesting because, of course, we saw the negative GDP print for the quarter. And that was basically in line with what the Atlanta Fed Now model had said about this quarter. It's actually a little bit better than what they had said in terms of what the drop could be. And if you add that to the fact that there might be communications between Beijing and the White House, and of course, the who blinked first element is also in play there, and bring that into the fact that the Fed's going to talk next week probably about how growth has slowed, not necessarily will they cut rates, because there's still, the idea of tariffs looming and inflation looming, but opening the door to doing something with respect to the lower GDP figure. So if you put that all together, what markets ultimately want is for the uncertainty to go away. And if you have a number of signs that indicate it's either gotten to its worst point or it might be waning, the markets are taking that with an optimistic upward motion.
But it feels like there's still so many ifs in this equation here. If we see China and the U.S. come together, if we see deals come through between the U.S. and the other countries that have been given this delay, and if the Fed acts to cut rates, and if those rate cuts actually feed through to the economy and improve the growth picture. So to my mind, investors are showing a degree of complacency here, given how many ifs are still on the horizon.
There's definitely all those ifs, but I think what investors are doing is saying, all right, but can it get worse? Is the downside of the ifs worse than the potential upside of the ifs? And what's basically happening is sort of that risk on momentum is entering the market as a result. CEOs right now are coming in and saying, look, we've had to sort of reduce our expectations of growth, of CapEx investment and so forth going forward, because we don't know what's going to happen with tariffs. So the expectation is, will we know more in 3 months from now? Will we know more after this sort of post-Liberation Day pause goes away, or will it get worse? We don't know that right now. And I agree, there is some complacency about what could happen. But the expectation is that the bad news, or the worst of the news, is coming into the markets right now. And if the worst of the news makes the Fed ultimately cut rates more quickly or buy more than they had forecast in December, even at the last FOMC meeting, then that indicates that any of this waiting on investment, even in this period of uncertainty to the markets, could be met with lower cost of capital, could be met with, that's sort of more of a liquidity boost. Whether that happens or not, yes, is still a big if. There could at any moment be an additional downside between any conversation that happens between China and the United States with respect to tariffs. There's no out of the woods yet, but there is a feeling that the markets are saying, all right, well, maybe
Right.
the worst is over. We can't get worse than 145% tariffs between countries right now.
Nomi, can I just make the point that I don't think the data is helping? And we had the GDP numbers to get through this week, and they were just a mix of everything. If you look at what we've got in some of the numbers on the jobs front, that's going to be all important today. We had really weak numbers in January, middle-of-the-diddle numbers in February, then a bounce back in March. And the same if you look at some of the consumption patterns. We had some anomalies in January. We had wildfires, of course, and winter to get through. Then we saw a bit of a middle-for-diddle number in February again, and then we bounced back in March. So my point is, the numbers are all over the shop, which is not helping giving us clarity on the direction for the economy. What would you say to that?
Well, the economy is definitely slowing, not just because of the GDP print, but because of the uncertainty that went into this period, because consumer confidence is down at a sort of COVID level low right now, because McDonald's has come in and said we've had our sales down by 3.6%, which indicates that the bottom or the middle part of the country that would go out and sort of buy fast food on a sort of more prevalent basis is stepping back. And that's net of, the discussion that just had on Apple and whether they're going out and buying the latest iPhone or not in advance, or what they're doing on a technology basis, whether they're waiting for tariff, sort of fog to go away or not. So there are a lot of different numbers, and there is a lot of negativity in the overall economy because of the fact that uncertainty is been brought into this period, and we're still not out of that uncertain woods. So the numbers really indicate a path that was happening even in the wake of the election, which is that the economy has been slowing down. Inflation has kind of stayed, quote, sticky, but it's not horrible. And the Fed and the administration are having this battle as to whether or not rates should be lowered or whether or not behind the scenes QE should be continued. And I think that Powell wants to find a reason to meet this sort of lower economic moment and sort of and cut rates by more than he would otherwise have indicated.
Nomi,
and
I'm having to thank, and again, amazing. You know I love speaking to you. I'm having to fight with myself at the moment. I'm one of the biggest curmudgeons, one of the most cautious, bear-like people out there. And yet I am wondering whether the silver lining side of things, the glass half full, is actually the scenario we should be looking at a bit here now. I'm having the debates with everyone at the moment. People have got their jobs. People are earning more money than inflation, as you mentioned. The central bank can cut rates aggressively from here if needed. The support of the bond market remains in place. There will be trade deals left, right and centre, we think, over coming weeks and months as well. And the stock market has dramatically fallen for many, many sectors and many, many stocks from here. You're going to have to look at Nike, for instance, to see where we've come from as well. Nomi, is there an upside where, actually, despite myself, we're being too negative?
I think there's an upside in the markets. This doesn't necessarily mean there's an upside in the economy in terms of growth stepping up from this point. I think we're going to see anemic growth over the next quarter. It might not be negative growth, but it's going to be anemic. And if you adjust for inflation, it will be negative. Consumers are stepping back, but yes, they still increased spending by 1.8% in the last read. So they are hanging in there, and they are sort of waiting to see what will happen. So it depends on where we're looking. The markets do have that positivity right now because, again, a lot of these factors have gotten to what their worst is, and the markets really want rate cuts. And if we look at what happened last time, consumer confidence, for example, was this low in the wake of COVID. Of course, it was a different environment, but the Fed came down, as did other central banks, and aggressively moved rates down. They can't do that right now because inflation ticked up in the interim, obviously, but there is an expectation on the market side, on the investment side, that there will be that additional bump, that whether it's because of the political sort of warfare between the White House and the Fed actually makes rates move, or whether it's because this lower growth does, that will create an impact on the market, and that will create more sort of confidence externally, and that will create a positive environment, at least financially, if not economically first.
Nomi, really appreciate the insights. Nomi Prince, founder, Prinsights Global. Now, Nomi referenced the McDonald's print that we got yesterday. Let's dive into detail. McDonald's posted a 3.6% fall in same-store U.S. sales in the first quarter, its biggest contraction since the peak pandemic quarter ending in June 2020 and below analyst estimates. The company said traffic across the fast food industry from low-income consumers had declined nearly double digits on an annualized basis, and in a change from prior months, traffic from middle-income consumers had fallen by a comparable amount. To me, when I look at these results, that was one of the standouts, the fact that they've seen a downturn in traffic, not just from low-income consumers, but from their middle-income consumers as well, suggesting that what's happening consumer sentiment-wise in the U.S. is broad brush. We're seeing sentiment take a dip across income levels.
Which one of you mentioned BNPL for groceries? One of you mentioned it this week.
Oh, that was me.
Buy now, it was a couple of days ago, so I know none of us can remember.
No, exactly.
Buy now,
that rings a bell, was me.
Buy now, pay later for groceries,
Yeah.
plus McDonald's. Wow.
The falls that you're citing, though, it's down 10% on visits for the low and middle income areas. So those two areas, double-digit fall. That is significant when you're talking about fairly, decent drop. What's also jumping out to me is that the promotional activity, they've been relying on that for a while. $5 you spend and you get a bundled deal. So the promotional activity strips away at the margins as well. So they're not getting the footfall. They're having to discount the offering effectively. So they're being hit from all sides. And this is just as we talk about the US domestic market. What about internationally? Some of the survey data from McDonald's suggested, look, the tone internationally is also a little bit anti-American now because of the tariffs.
Coca-Cola sales in
Right.
Denmark.
But McDonald's is not necessarily flagging that on sales just yet, but they're saying in the sentiment readouts, it's there. So if it's someone saying, well, I'm not going to get a Big Mac now, I'm going to go and get something else because I don't want to buy an American product, that hits the international component.
The only thing I will say is the shares are yet to show a major problem. What's that one you got on the screen there, lads? Can you show me a slightly longer chart as well? I mean, any of the longer term charts, and even that chart just shows that there is a steady trajectory. Year to date, that one shows 8.2% higher. But on any of the charts, from the depths of COVID, they have had a fantastic run to the upside. Great chart. Thank you, Brittany. 71% higher over the last 5 years. And again, really interesting. This stock trades, if you're looking at one metric, and I haven't got Nvidia up, but it trades at 25 times forward. I would imagine it's very comparable to Nvidia, and I'm going to have a look now.
Can I make the obvious point that you can't stockpile fast food? I mean, it stockpiles on your body, but you can't stockpile it. So,
Karen, let's hope so. I don't mean to be dismissive of your point, but I'm going to probably disagree. I think you can.
So how would one stockpile?
It's called
food?
deep freeze.
Rude? So you buy McDonald's.
Oh no, what you mean as a consumer? I meant the manufacturer, the producer.
No, as a consumer. So I think what you've seen in the economy, even consumers trying to get ahead of the tariffs, they're buying some items that they think are going to be more expensive down the track. So you've seen that natural boost where a lot of company earnings have been protected by that stockpiling effect. But you can't see that in the fast food numbers because there's no way of doing that. So I think that's where it gets slightly dicey for this segment of the economy.
By the way, I was right. Nvidia
classic.
Boom, 23 times forward Nvidia. McDonald's is 25 times forward. Sorry.
Well, Karen, to your point about not being able to stockpile, so what do consumers do in a space like this if they anticipate changes to come? Well, they just cut down on visits, and that's what they're seeing at McDonald's. To your earlier point,
breakfast
what they're seeing,
home, right?
Breakfast at home or skipping breakfast altogether. That's what McDonald's is saying that their customers are doing.
Can I just say? There are certain foods you can eat the next day, yeah. Especially if you're of a student type. What pizza in the fridge?
Oh,
you can have that the next day.
Pizza.
Chinese food? I think so.
Definitely.
I think so. Curry? It's debatable.
Curry, I would say, gets better with age.
Can you eat? Oh, I can't have that quarter cheese and nuggets now. Can you eat that from the fridge the next day?
Karen and I were looking at you with disgust when you said you can stockpile, and we were like,
no, I meant the companies. I didn't mean the consumers. But
key
anyway, we'll
clarification.
leave that as the debate of the day. What fast food can you eat the next day?